Welcome. I'm Rachel Ivanovich here with Vince Stefano. We are here today to provide you with insights on investing, the markets, and tax planning. So here we are a week later, and guess what? Did we get our rate cut?
We got our rate cut.
Right.
It's kind of interesting because, prior to this rate cut, the markets there had a lot of jitters in the market. There was fear of a recession. The market was looking at whether there were going to be more growth or less growth. The Fed started looking at, less inflationary pressures, more about growth and jobs. We were seeing that any good news as far as rate cuts, any good news on macro, the market was reacting very favorably. Any falling bond yields, the market was reacting favorably. And that was prior to yesterday. And then yesterday, the Fed comes out and they decide to cut 50 basis points.
We're excited.
What's interesting is as when they cut 50 basis points, I was shocked at how the market reacted. It reacted very favorably immediately, but then throughout the day, it was up and down like a yo-yo, and it eventually closed down. Today's a completely different story. We're having a huge rally in the markets. Everything is moving, everything from technology stocks to food stocks. And what was I found kind of interesting yesterday, there was a 100% chance of a 25 basis point cut. When they did 50, everybody started questioning, does the Fed know something that the market doesn't know?
That's a good question.
And that's still on everybody's mind. Now, it's having a very positive reaction today, but that could change as we still have 7 trading days left in September. September is a notoriously bad month for stocks. However, 50 basis points is big for the Fed. And it's only happened 3 times in the last 25 years. And so, you keep asking yourself, is the economy in worse shape?
Well, when I heard rate cut, all I could think of was clients are going to be calling me. They're going to refinance their homes, and then they're going to say, well, what is it going to do for my taxes? Believe me, in 2021, everyone refinanced their home, and so we had all the loan statements when we were doing tax returns. So if you do refinance your home, make sure that you're getting your settlement statements over to your tax advisors and let them know you may have to change your withholding, because think about it. If you're paying a ton of mortgage interest and then all of a sudden your rate goes down, that's that much less of a write-off that you have. So definitely want to keep that in mind.
Well, I think that's great news for the real estate market. I think it's great news for consumers who are carrying a lot of debt on credit cards.
Yes,
I think it's
absolutely.
good for consumers that want to go out and maybe, buy an automobile because, again, rates have been, very, very high, artificially high since the Fed has been, jacking them up the last few years. What's interesting, I saw today for the first time in a long time, we have a steepening of the yield curve. Up until yesterday, it's been inverted.
Yeah.
But today, the 2-year Treasury was at 3.57%. The 10-year was at 3.71. So we're finally getting that steepening yield curve. And, there was all that talk about inverted yield curves leading to a recession. We didn't see a recession. I don't know if we're going to have one going forward. I highly doubt it, but you never know what can happen to the economy. What's real interesting now, though, is with rates coming down, it puts a lot of good, positive momentum on stocks, especially on technology stocks, because those stocks that have significant amounts of free cash flow going forward, they're now going to be more valuable. So look to companies that are throwing off significant cash flow and have upwardly moving operating margins, because all of that is cash through their balance sheet, and that's what investors want to see going forward. I don't know what's going to happen with some of the money market rates. And, there's $6.5 trillion sitting in money market funds. If the Fed continues to lower rates, and they may do another 25 by the end of the year, that puts a lot of pressure on investors to decide what they want to do. So I firmly believe the Fed is pushing us back into risk assets. And you
were saying that this week, yeah.
And you as an investor have to figure out, one, do you want to stay in lower yielding fixed income? And if the rate of inflation doesn't come down significantly, but yet your money market or CD rate does, when you factor inflation and taxes, your real rate of return could be flat to negative. Now, if your real rate of return is up 1% and the market's down 20, you look like a hero. But believe me, when the market's up 20 and you're getting 1%, that's not all that great. So I think you have to talk to your investment advisor, obviously, figure out what's the best avenue going forward. I continue to say where investors want to be in the next 18 months to 24 months, rapidly growing companies, very high quality, dominant names that have great products, great services, an ever expanding market share. Because what drives stock prices? Revenue and earnings. And that's what you want to see from good companies. Now, from a tax standpoint, there's a lot of stuff that can happen because the market is still focused on the uncertainty of the election. And you're probably hearing a lot of stuff in the tax world. So
we're expecting a lot of changes in the tax world. We haven't had a big change really since the Tax Cuts and Jobs Act of 2017, which most of those provisions will expire at the end of 2025 unless they're made permanent. So there's going to be a lot of changes over the next couple of years in the tax world.
And again, as we've said in the past, the markets do well under Democratic as well as Republican administrations. I think the big question becomes, how are certain taxes going to affect, number one, corporate taxes, individual taxes, but more importantly, capital gains taxes, and this whole notion of taxing unrealized capital gains.
We're not even going to go there, Vince.
We're not
going. Not yet. Not yet.
And I'm thinking to myself, that can hurt the market.
All of the tax advisors will quit. We'll just say, nope, we're not doing that anymore. It'll be too much of I can't even imagine. So let's not even go there yet.
So, okay, we won't go down that road until
I have about 25 more days of tax season for 2023. So October 15th is looming, and we're finishing up all of our extensions, and we've got all of our procrastinators who are showing up and getting ready to file. So
now, do people have to do more like do they send in more tax, just pre-tax payments or something?
Monday was the third quarter estimated payment deadline.
Mm-hmm.
Yes, the 16th of September. So our next quarterly is due in January. So people have time to get their books in order. And but it is a really good time to start looking at your records, make sure that you're ready for tax season. And like I said, if you're going to refinance your house, make sure you keep that paperwork and send that in to your tax advisor.
Yeah, one quick question though. With the RMD season coming up, what do you advise your clients to do? Do you advise them to take the RMD and reinvest it?
Or it depends on their individual situation. Everybody's different. But it's a good time of year to look at Roth conversions. It's a great time of year to really do a portfolio review and see if you can do any tax loss harvesting, whereas you offset your gains with your losses. That also helps to offset capital gain distributions. So it's a really good time of year to look at, okay, what is my year-to-date income, and what am I projecting from now through the end of the year? How much have I had withheld on my paychecks or on my IRA distributions or whatever, wherever you have withholding, and to make sure that you've paid in enough for the year, but not too much, because you don't want to give free loans to the government. Just saying.
Well, and again, I'm all in favor of investors speaking to their advisors about how they're going to position their portfolios going forward. Just remember that what drives markets is growth. Growth drives stocks, and and growth will drive the economy. And what you really want to focus on are those companies that have above average growth rates going forward, because that's where the investor will make a significant amount of money. So I say, hey, take a look, do your fundamental analysis, figure out, do you want to stay in lower yielding fixed investments, or do you want to move to more kind of risk investments.
And talk with your tax advisor at the same time too, because maybe you've got a situation in your portfolio or your tax situation where you've got carryovers that you could utilize. So you may want to reposition things, sell some things, but you want to make sure that the tax efficiency is there too.
Good. I've pretty much that's kind of like my talk for today. I don't have a whole lot more to say. I do want to see how the market's going to react over the next 7 or so trading days of September, because all of that spills into October. People start thinking about October, of years back, of October of '87, and their gypsy blood starts to boil, so they get a little nervous. However, I think that we've already had some significant corrections in the market this year. But it's rallied back because people believe that the best place to be is our American economy and American stock market.
Well, I think that's a wrap for the week, and we will see everyone next week. It was really fun to hang out with you, Vince.
Yeah, good. You too, Rachel. Hey, trade well, guys.
All right. Thank you.
Please stay tuned for important regulatory disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Wolf Wiese Magana, LLC, doing business as WWM Financial, Savvy Doc Financial Planners, and Savvy Woman Wealth Management, is a registered investment advisor with the SEC.